Why people take out personal loans, and what to consider if you do. You can use a personal loan to knock out debt, finance a big purchases or plan the wedding of your dreams, but make sure you factor in the costs. Few people have the cash they need on hand to pay for big-ticket items up front. That's why it's not unusual for people to take out mortgages, car loans and student loans, so they can pay for these costly expenses over time. But when it comes to other major purchases like home renovations, engagement rings, medical bills, an increasing number of Americans are turning to personal loans to help manage the cost. Personal loans are the fastest growing debt category, according to a 2019 Experian study. While mortgages still made up the largest portion of consumer debt, 71.7%, in 2019, Americans reportedly took out personal loans at a faster rate than auto loans, mortgages, credit cards and student loans. A form of installment credit, personal loans are sometimes used as an affordable alternative to credit cards because they generally charge lower interest rates. Personal loan APR averages 9.34% according to the Fed's most recent data. Meanwhile, the average credit card interest rate is around 16.6%. Unlike with revolving credit, you don't continue to have access to your loan once you pay it off, a plus for people concerned with getting in over their heads with spending. Here are some ways that people use personal loans. 1. Paying off debt. Debt consolidation is the most common reason that people take out personal loans. The average American has about 4 credit cards in their wallet, and when you run up a balance on multiple cards, it can be difficult to manage all the different bills and APRs. A personal loan can streamline your payments into one monthly bill. Personal loans can also save you on interest. People who refinance high-interest credit card debt can save money with a lower APR. 2. Home renovations. You want to do a home remodel. If you want to renovate your home but don't have much cash on hand, you might consider a personal loan to help finance those activities. If a remodel is going to make your home a more ideal living space for you and your family, it qualifies as smart use of personal loan money, especially when weighed against the option of buying a new home and looking at a full mortgage. About 17% of consumers in Experian study used their loan for home improvements. Whether you're looking to do a full gut job or just upgrade your appliances, a personal loan gives you the option to pay for home repairs with an installment plan. Spending a few $100s per month is probably more realistic for many Americans than dropping $20,000 at once on a new kitchen. However, keep in mind that you pay interest to use a personal loan and the renovations will end up costing more in the long run. If you're not in a rush to do the renovation, it could be more cost-effective to make a plan to save the cash you need instead of taking on more debt. 3. Education. Federal student loans are usually the best choice to get a flexible, low-interest loan to pay for college. But if you're just looking to take some online courses or develop a new skill to help advance your career, a personal loan can be a good option to help you afford the education you need to get a better job or qualify for that promotion. Before you sign up, be sure to check for no-cost alternatives first, such as asking your employer whether they sponsor employee professional development. And if you're looking to make a career shift, research what kind of salary you can expect to bring in once you complete your education. It's important to know if you'll be able to afford the loan's monthly payments with your new, and hopefully improved, salary. That will help you decide if the costs are worth it. 4. An emergency. You are facing a significant unplanned expense. Probably the most apparent reason to consider a personal loan is if you are facing a considerable unforeseen or emergency expense. Perhaps you or a family member has fallen ill or been grievously injured, and you are facing medical bills beyond what you can afford. Maybe a parent passed away recently, and you are planning their funeral. Perhaps your home was damaged by a storm, and you need a loan to pay for what the insurance won't cover. These situations are challenging to plan for, which makes affording the associated expenses a considerable burden. A personal loan can help. Unfortunately, many people can't afford to save for emergencies, and you may need a personal loan to help you cover a car repair, medical bill, or day-to-day expenses if you suddenly lose your job. Before you decide to go this route, research all your options. See if you can negotiate down the costs, or set up a payment plan with the mechanic or your healthcare provider. And if you've lost your job, find out what unemployment benefits you qualify for so that, if you still need a loan, you can minimize the total amount you need to borrow. 5. You need to consolidate debt. One of the best reasons to get a personal loan is to consolidate other existing debts. Let's say you have a few existing debts to your name: student loans, credit card debt, etc., and are having trouble making payments. A debt consolidation loan is a type of personal loan that can yield two core benefits. First, you boil all your disparate debts down to a single loan, making it easier to keep track of and pay on time. Second, you may be able to replace high-interest debts with a lower-interest loan, which can cut down on how much interest you pay in the long run. 6. Wedding costs. If you and your partner are comfortable with the idea of taking on debt, you might want to consider a personal loan to pay for your wedding expenses. Of course, your wedding doesn't have to cost nearly as much as the average, but if celebrating your special day in style is high priority, crunch the numbers to see if a loan is the best way to cover the costs. Again, it's important to have a clear payoff plan and understand how the monthly loan payments will impact your overall budget. And if you've got the wedding covered but need cash to pay for the engagement and/or wedding ring, you could look into financing that with a loan, too. 7. A major life change. Moving, divorce, career changes, etc. come with emotional and financial costs. As much as possible, plan ahead for these transitions, but if you're in a pinch and need money to hold you over, you may be able to get a personal loan in a matter of days. 8. Vacations. Increasingly, airlines and travel companies are offering point-of-sale loans to customers who want to escape the winter blues and get away. You can also fund your vacation with a personal loan, though it's not advised. There are better ways to travel that don't drain your resources. If you're fortunate enough to have disposable income, challenge yourself to put it into an existing or new savings account before you borrow money. The Ally Online Savings Account is a good option to save for vacations because you can create up to 10 buckets, or funds, within the same account. This helps you organize and keep track of your savings goals so you don't have to borrow unnecessarily. What to consider before taking out a personal loan. While the notion of fast cash sounds great, remember that you'll have to start making payments on your personal loan right away, usually within 30 days. Before you take out a personal loan, make sure you have a clear purpose for it and a plan to pay it back. Keep these things in mind when you do your research. Interest rates. Most personal loans come with fixed rate APRs, so your monthly payment stays the same for the loan's lifetime. In a few cases, you can take out a variable rate personal loan. If you go that route, make sure you're comfortable with your monthly payments changing if rates go up or down. The size of your loan. Lenders offer a wide range of loan sizes, from $500 to $100,000. Before you apply for a loan, consider how much you can afford to pay each month. The loan's term, the length of time you have to pay off the loan, is usually between 1 and 7 years. The longer the term, the smaller your monthly payments and the higher your interest rates. Fees. Some lenders charge origination, or sign-up, fees, but it's possible to avoid these fees. Thank you for being with us, and don't forget to subscribe and share this video.